Hello, Dividend Kings. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners here of Dividend Kings. And for this week's FastGraph Friday, I'm going to take a look at Bristol Myers Squibb. It's on our top buy list and one of our favorite stocks. In fact, in a recent Q&A session, Adam Gallus, Dividend Sensei, actually picked Bristol Myers as his favorite pick. So it's on our top buy list. It's an extremely high quality company. And what I want to do is kind of give you a review of why we like it and what's going on. Now, many of you, if you follow the company at all, will know that they recently merged with Celgene and they've now become a much bigger company. And what's been happening in the big pharma, even the big names like Merck and Pfizer, these were very strong growth stocks years ago. But in more recent times, their growth has slowed quite a bit. So for example, I'm going to take price off the graph here, and I want you just to see the company's growth rate. If I bring this back pre-2015, I want you to notice that the growth was actually negative. In other words, the company had very poor growth during that period of time. But then as I kind of move the bar here, growth started to happen again. You can see by 2016. And then if I go all the way out to current, including estimates, you'll see that the growth rate has now once again become double digits. And these companies used to grow at double-digit rates many years ago. Now, when I add monthly closing stock prices to the graph, I do want you to see how valuation works. So I'm going to go ahead and extend this out back to a longer-term graph again, because I want you to see I've got a 15 PE ratio here utilizing the extrapolated Graham-Dodd formula. So this is a 15 PE fair value reference line. The normal PE over this time frame came out at around 18. But the point is that, other than a couple of rare periods of time here, most of the time this stock trades between a 15 and 18 PE, and I consider that fair value with a good earnings yield. Right now, I do want you to notice the company is under the orange line, but what I really want you to see here is the acceleration that we're now seeing in this growth of the company. A lot of it, I think, attributed to the merger between Celgene and Bristol Myers, which is, I think, a tremendous opportunity. By the way, the company's A+ rated, has 44% long-term debt to capital, which is quite good in my opinion. It currently can be available right at a 3% yield. I think the stock's down a little today, so it's probably giving us a 3% yield. But, I'm known as Mr. Valuation, and I always talk about valuation. And although as much as I like valuation, I equally like growth. And that's something that I think don't feature or focus enough on when I'm talking about stocks and talking about, companies and basically sharing my overall investment philosophy. What I really like about Bristol Myers here is I think it has the combination of extremely high quality, good dividend income with a really good dividend record. Now, the company historically, they have frozen their dividend. In coming out of the 2001, they did freeze their dividend for several years. I think 2 more years than I'm showing here. But then since that time frame, the dividend has been growing. And, there are times when it grew, like coming out of the Great Recession, they didn't raise the dividend very much. They raised it 7.8% in '08 and then only less than 1% in '09. But then more recently, it's been growing at 2.5%, 3%, and last year, 4.3%. Now, I'll be talking about dividend coverage here a little bit more as I go through this video. But what I really want you to see here is that in light of what's going on with the COVID virus and so on, let's look at forecasting because I find this very interesting. The consensus of leading analysts following the company expect growth of about 30% for this fiscal year. Now, keep in mind, we have a little mark here because there's an asterisk on that simply because we have, the Celgene merger here. So that's part of what's supercharged the growth here. But what's interesting is if you look at the forecast 6 months ago, it was $6.10, which is what it currently is. The high here was $6.19. So even though we've had a lot of companies showing a significant big changes in their forecasting, the analysts, and there are 14 analysts following their reporting on this company, still are holding their estimates pretty much intact. For 2021, the estimate's $7.37. Now, it was $7.92 6 months ago, and it dropped to $7.23. And then the most previous estimate, which is the current estimate, is $7.37. So estimates have been holding up quite well. For 2022, we are expecting growth to slow down to about 6%, and there's 12 analysts making that. But I like to live in this this realm right here, the next two estimates, because I would believe that those will likely be the most accurate. But let's put this now into perspective. If we went ahead and applied the 15 PE ratio that I talked about a minute ago, by year end, this ought to be around a $90 stock, and that would give us an annualized rate of return of 87%, which is obviously because we don't have a full year there. But if I push it out to 2021, we'd be looking at an annualized rate of return of 45%. And even if I go ahead and include these numbers, we'd still be looking at an annualized rate of return averaging about 28% a year. Now, of course, if I use the normal multiple, which has been much higher, then these potential rates of return would be significantly higher. But here's the point I'm trying to make here. I believe this has the really good combination of above market yield, moderate dividend growth, but it's significant, or I wouldn't call it significant, but I would call it attractive undervaluation coupled with some really strong expected growth going forward. If I go back to forecasting and look at the trend line 3 to 5 year growth, and there are 5 analysts in the FactSet database currently, they expect 10.1% growth. Now, sometimes I like to check this against other forecasting tools. So let's go ahead and look at what the analysts from Reuters say 12.15%. Bottom line is that's, within the same range of what we're seeing here. We got 10 to 12% growth going forward. So there's a lot of growth expectation for this company. They've just made some really pretty strong announcements about some products. There's a couple of their drugs that are forecast to be extremely large selling drugs by 2024. So I think the company's really in the sweet spot. I think it has a very safe and extremely well covered dividend. And let's look at that very quickly here. Let's look at operating cash flow, which I like to look at. And this is something that, the company's operating cash flow has been weaker historically. But again, in more recent years, and then in conjunction with the Celgene acquisition, we've got operating cash flow just significantly covering the dividend expectations here. And we have a similar situation with free cash flow. I don't have estimates on free cash flow, but I can show you that free cash flow is also expected to be real strong here in the next coming year. So I think the company is extremely well, or covering their dividend extremely well. That's something that I think is very important. Now, when I look at EBITDA, which is a softer form of cash flow, I like to call it, because again of the acquisition, we get this huge surge in EBITDA, which is also what I would call attributable to the growth thesis that I'm kind of sharing here. EBITDA growth is also expected to be real strong going out for the next couple of years. So all in all, I really like this company. I think it's a great selection for anyone who's looking for above average dividend income, but also some capital gain potential, especially out over the next 3 to 5 years. So anyway, this has been Chuck Carnevale saying thanks for watching. If you like what you see here, don't forget to subscribe to my YouTube channel. I would appreciate it. Everybody stay safe and happy investing. These are trying times here, but there are some good opportunities, and I think Bristol Myers Squibb is one of them. Thanks for watching.